flexible source of funds for unexpected emergencies, or the capital to finally tackle that dream kitchen renovation, all without selling your home. Sounds appealing, right? This isn't a fantasy. It's the potential of a home equity line of credit or HELOC. But like any powerful tool, it comes with its own set of rules and risks. Many homeowners overlook the incredible potential locked within their home's value, or they're intimidated by the jargon surrounding options like a home equity line of credit, often called a HELOC. You might have heard whispers of variable rates or the idea of using your home as collateral and felt a bit uneasy. But used wisely, a HELOC can be one of the smartest financial instruments at your disposal. I'm Duane Buziak, your Senior Mortgage Loan Officer. Today, we're going to demystify the home equity line of credit. We'll define exactly what a HELOC is, how its unique revolving credit structure works, and explore its top smart uses, from funding dream renovations to consolidating high-interest debt or building a robust emergency fund. But just as important, we'll transparently cover the potential pitfalls and risks, like rate volatility and the serious implications of using your home as collateral. My goal is to empower you with clear, accurate information so you can make informed decisions about leveraging your home's equity. And I'll show you how my team and I have made accessing this powerful tool faster and easier than ever before. Let's dive in. At its core, a home equity line of credit, or HELOC, is a type of loan that allows homeowners to borrow money against the equity in their home. Think of it as a flexible, revolving line of credit, much like a credit card, but with one crucial difference. It uses your home as collateral. This means you can borrow, repay, and borrow again up to a certain pre-approved limit, using the value you've built in your property as security. Let's break down the key components of a HELOC to truly understand how it operates. First, equity as collateral. Your home's equity is simply the difference between your home's current market value and the outstanding balance of your primary mortgage. For example, if your home is currently appraised at $400,000 and you still owe $250,000 on your first mortgage, you have $150,000 in equity. A HELOC allows you to tap into a portion of that equity, typically up to 80% or 90% of your home's total value, minus your first mortgage balance. So, in our example, if a lender allows you to borrow up to 85% of your home's value, that would be $340,000. Subtract your $250,000 first mortgage, and you could potentially access a HELOC of up to $90,000. This equity acts as the security for the HELOC, which means if you default on your payments, the lender has the right to take possession of your home. This underscores the seriousness of using your home as collateral and the importance of responsible borrowing. It's a powerful tool, but one that comes with significant responsibility. Second, a HELOC offers revolving credit. Unlike a traditional fixed loan where you receive a lump sum up front and begin repaying it immediately, a HELOC provides a line of credit that you can draw from as needed. This flexibility is a major advantage. Imagine you have a $50,000 HELOC. You can draw $10,000 for a renovation project, repay it over a few months, and then draw another $5,000 for an unexpected expense. You only pay interest on the amount you've actually drawn, not on the entire approved credit limit. This makes it incredibly efficient for ongoing needs or unpredictable expenses, allowing you to manage your cash flow more effectively. It's like having a flexible financial reservoir you can tap into as required, rather than a single large, one-time withdrawal. Third, HELOCs typically feature variable interest rates. This is a critical point to understand. Unlike a fixed-rate mortgage, where your interest rate remains constant for the entire loan term, a HELOC's interest rate can fluctuate based on market conditions. The rate is usually tied to a public index, most commonly the prime rate, plus a margin set by your lender. For instance, your rate might be prime plus 0.5%. If the prime rate goes up, your HELOC interest rate and, consequently, your monthly payments will also go up. If the prime rate goes down, your payments will decrease. This variability introduces a level of uncertainty, which we'll discuss more when we cover the pitfalls. However, it also means you can benefit when rates fall, potentially leading to lower costs over time if the market moves in your favor. It's a trade-off between stability and potential savings or increased cost. Finally, a HELOC operates in two distinct phases, the draw period and the repayment period. During the draw period, which typically lasts 5 to 10 years, you have the flexibility to borrow funds as needed, up to your approved credit limit. During this period, your monthly payments might be interest only, or a small percentage of the outstanding balance. This keeps payments low and maximizes your access to funds during the time you're likely to be using the credit line. Once the draw period ends, you enter the repayment period, which often lasts 10 to 20 years. At this point, you can no longer draw new funds. Your payments will typically convert to fully amortizing principal and interest payments, designed to pay off the entire outstanding balance by the end of the repayment term. This shift can lead to a significant increase in your monthly payment, often referred to as payment shock, if you've only been paying interest during the draw period. Understanding these two phases is paramount for long-term financial planning with a HELOC, ensuring you're prepared for the change in payment structure. To access funds from your HELOC, lenders offer various convenient methods. You can typically write checks against your line of credit, use a credit card specifically associated with the HELOC, or make online transfers directly to your bank account. This ease of access is part of what makes HELOCs so appealing for immediate financial needs, allowing you to quickly tap into your home's equity without a lengthy reapplication process for each new need. Smart uses of a HELOC, leveraging your home's power. When used strategically and responsibly, a HELOC can be an incredibly powerful financial tool, helping you achieve significant goals and navigate life's unexpected turns. It's not just about borrowing money, it's about smart financial management. Here are some of the top smart uses for a home equity line of credit. 1. Home renovations and improvements. This is perhaps the most popular and often recommended use for a HELOC. If you're planning a kitchen remodel, a bathroom upgrade, adding a new deck, finishing a basement, or undertaking any significant home improvement project, a HELOC can be an ideal financing solution. Unlike a traditional home equity loan that gives you a lump sum all at once, a HELOC's revolving nature is perfect for projects where costs might be uncertain or spread out over time. You can draw funds as needed for materials, contractors, and unexpected expenses that often pop up during renovations, paying interest only on what you use. This flexibility means you're not borrowing more than you need, and you can manage cash flow effectively throughout the project. Furthermore, the interest on a HELOC used for substantial home improvements can often be tax deductible, though you should always consult a qualified tax advisor for personalized advice regarding your specific situation. By investing in your home through improvements, you're not just enhancing your living space and comfort, you're potentially increasing its market value, further building your equity and creating a positive financial cycle. 2. Debt consolidation. If you're carrying high-interest debt, such as credit card balances with rates of 18%, 20%, or even higher, or personal loans with less favorable terms, a HELOC can be a game changer. By consolidating these high-interest debts into a lower-interest HELOC, you can significantly reduce your monthly payments and save a substantial amount in interest over time. The interest rate on a HELOC is typically much lower than unsecured debt because it's backed by your home, making it a less risky proposition for the lender. This strategy can simplify your finances by combining multiple payments into one, and it provides a clear path to paying off debt faster and more efficiently. However, it's crucial to address the underlying spending habits that led to the high-interest debt in the first place. If you consolidate debt only to run up credit card balances again, you'll find yourself in a worse financial position, with more debt secured by your home. This strategy works best when accompanied by a commitment to responsible budgeting and spending. 3. Emergency fund or financial cushion. Life is unpredictable. Unexpected medical bills, a period of job loss, major home repairs not covered by insurance, or significant car repairs can quickly deplete savings and create financial stress. A HELOC can serve as a robust emergency fund, providing a safety net of readily available cash. Instead of keeping a large sum of money in a low-interest savings account, you can maintain a HELOC as a backup. You only pay interest if you draw on the line of credit, so it costs nothing to have it available for genuine emergencies. This provides immense peace of mind, knowing you have access to funds for genuine emergencies without having to sell assets, liquidate investments prematurely, or take out high-interest personal loans. It's a smart way to manage liquidity while keeping your primary savings invested or growing in higher yield accounts. 4. Education expenses. Funding higher education, whether for yourself or your children, can be a significant financial burden. College tuition, living expenses, and books add up quickly. A HELOC can be a viable option to cover these educational costs. Compared to private student loans, which often have higher variable interest rates and less flexible repayment terms, a HELOC can offer a lower interest rate due to its secured nature. Its revolving credit structure is also beneficial for covering expenses that are spread out over several semesters or years, allowing you to draw funds as needed rather than taking out one large loan up front. This can help manage the financial flow of education costs more efficiently. As with home improvements, the potential tax deductibility of interest on a HELOC used for education can be an added benefit, though again, always consult a tax advisor. 5. Major life events and planned expenses. Beyond emergencies, a HELOC can be a smart way to finance other significant planned life events. This could include covering adoption expenses, financing a wedding, or bridging a financial gap during a career transition. Its flexibility allows you to access funds precisely when you need them for these large, infrequent expenses, without committing to a fixed loan amount from the start. This provides financial agility to manage life's big moments. 6. Investment opportunities. Use with caution. For savvy and experienced investors, a HELOC can sometimes be used to seize time-sensitive investment opportunities, such as purchasing a second property, investing in a business, or capitalizing on a market dip. Because a HELOC offers quick access to capital, it can be useful for those who need to act fast to secure an opportunity. However, this is a higher risk strategy. While the potential rewards might be greater, so are the risks. Using your home as collateral for investments means that if the investment goes south, your home is on the line. This approach should only be considered by experienced investors with a clear strategy, a deep understanding of the risks involved, and a high tolerance for potential losses, and always with professional financial advice. It's not for the faint of heart or the inexperienced. In all these smart uses, the key is responsible planning and understanding the implications. A HELOC is a powerful tool, and like any powerful tool, it demands respect and careful handling. It's about strategic borrowing, not just borrowing because you can. The pitfalls and risks of a HELOC. What you need to know. While HELOCs offer incredible flexibility and potential benefits, it's crucial to understand their inherent risks and potential pitfalls. Transparency is key to making an informed decision, and my role is to ensure you're fully aware of both the upside and the downside. Ignoring these risks can turn a smart financial move into a significant burden. 1. Variable interest rate volatility. This is arguably the biggest risk associated with a HELOC. As we discussed, HELOC rates are typically variable, tied to an index like the prime rate. If the prime rate, which is heavily influenced by the Federal Reserve's monetary policy, increases, your HELOC interest rate will also increase. This means your monthly payments can go up, sometimes significantly, even if your outstanding balance remains the same. In a rising interest rate environment, this can put a severe strain on your budget and make your HELOC much more expensive than anticipated. While most HELOCs have lifetime rate caps, limiting how high the rate can ultimately go, they can still reach levels that are uncomfortable or even unaffordable for your budget. It's essential to assess your ability to handle higher payments, perhaps by calculating what your payment would be if the rate hit its cap before committing to a HELOC. Don't assume rates will always stay low. 2. Your home as collateral/foreclosure risk. This is the most serious pitfall, and it cannot be overstated. A HELOC is a secured loan, meaning your home serves as collateral. If you default on your HELOC payments, the lender has the legal right to foreclose on your home, just as they would with your primary mortgage. This means you could lose your home if you're unable to make payments. It's absolutely critical to remember that you are putting your home at risk when you take out a HELOC. This is not like an unsecured credit card or personal loan, where the worst outcome is damage to your credit score. Here, your primary residence is on the line. This risk means a HELOC should only be used for necessary or value-adding purposes, not for discretionary spending that could jeopardize your home. 3. Temptation to overspend and accumulate debt. The revolving nature and easy access to funds can be a double-edged sword. Because you can draw money as needed, repay it, and then draw again, there's a significant temptation to treat a HELOC like an extension of your checking account or a perpetual source of funds. This can lead to overspending and accumulating more debt than you can comfortably repay, especially if you're only making interest-only payments during the draw period. It requires strong financial discipline to use a HELOC wisely and avoid falling into a cycle of increasing debt. Without a clear plan and strict adherence to it, a HELOC can become a pathway to deeper financial trouble rather than a solution. 4. Payment shock at the end of the draw period. As mentioned earlier, a HELOC has a draw period, e.g., 5 to 10 years, followed by a repayment period, e.g., 10 to 20 years. During the draw period, you might have the option to make interest-only payments, keeping your monthly outlay low. This can be appealing, but it means you're not paying down any principal. However, once the draw period ends, your payments will typically convert to fully amortizing principal and interest payments, designed to pay off the entire outstanding balance over the remaining repayment term. This can lead to a substantial and sometimes unexpected increase in your monthly payment, creating payment shock if you haven't planned for it. It's vital to understand what your fully amortized payment will be before the draw period ends, and ideally, start making principal payments during the draw period to mitigate this future increase. 5. Potential for a reduced credit limit or line freeze. Lenders have the right to reduce your HELOC credit limit or even freeze your line of credit entirely under certain circumstances. This can happen if your home's value significantly declines, meaning your equity cushion shrinks, if your credit score drops substantially, or if there are major negative changes in economic conditions that increase the lender's risk. If your line is reduced or frozen, you might lose access to funds you were counting on for a project or emergency, or you could be forced to repay a larger portion of your balance immediately. This introduces an element of uncertainty in your access to funds, especially when you might need them most. 6. Closing costs and fees. While often lower than a full mortgage refinance, HELOCs typically come with their own set of closing costs and fees. These can include appraisal fees, title search fees, attorney fees, and administrative charges. Some lenders offer no-cost HELOCs, but these usually come with a slightly higher interest rate to compensate the lender for waiving the upfront fees, meaning you're still paying for them, just in a different way. It's important to factor these costs into your decision-making and compare the total cost of a HELOC, including fees, across different lenders. 7. Impact on future mortgage refinancing. Having a HELOC, a second lien, on your property can sometimes complicate or add costs to refinancing your primary mortgage in the future. You might need to pay off the HELOC, or the HELOC lender might need to resubordinate their lien, which can involve additional fees and paperwork. This is something to consider if you anticipate refinancing your first mortgage in the near future. Understanding these risks is not meant to deter you from considering a HELOC, but rather to ensure you approach it with caution, a clear strategy, and a full awareness of the potential downsides. Responsible use is key to making a HELOC a beneficial financial tool. Accessing your HELOC with speed and ease. Introducing Duane's automated solution. Navigating the complexities of HELOCs, understanding the fine print, and finding a lender that truly puts your needs first can be daunting. That's why I'm incredibly excited to share a solution that simplifies this process, making it faster, easier, and more transparent than ever before. I'm Duane Buziak, and my team and I are proud to offer a new, fully automated HELOC application process through digitalhelocs.com. This isn't just about getting a loan. It's about providing you with a seamless, credit-safe path to accessing your home's equity, designed with your convenience and financial security in mind. What makes our automated HELOC application stand out? Speed. Forget weeks of waiting and endless paperwork. Our digital platform is designed for efficiency, allowing you to complete your application quickly and get a decision much faster than traditional methods. Time is money, and we respect yours. What used to take days or even weeks of back and forth can now be accomplished in a fraction of the time, getting you access to funds when you need them most. Ease of use. The application process is intuitive and user-friendly. You can apply from the comfort of your home, on your schedule, using any device, without the need for multiple in-person meetings or mountains of physical documents. We've streamlined the experience to minimize hassle and complexity, making it accessible even if you're not a tech expert. Our guided process walks you through each step clearly. Credit-safe soft pull process. This is a huge benefit and a key differentiator. When you initially check your eligibility and get pre-qualified through our digital platform, we utilize a soft pull on your credit. This means your credit score will not be negatively impacted by the inquiry. You can explore your options and understand your potential HELOC limit without worrying about dinging your credit score, giving you peace of mind as you shop and compare. This allows you to confidently assess your borrowing power without any adverse effects on your credit profile. But beyond the technology, what truly sets my service apart is my commitment to your bottom line, the whole deal. I believe that securing the best financial solution for you goes far beyond just shopping for the lowest interest rate. While I certainly leverage my extensive network of lenders to shop your rate aggressively, that's just one piece of the puzzle. My holistic approach means I look out for your entire financial package, ensuring you save money at every possible turn. This includes realtor rebates. I have cultivated strong relationships with a network of trusted realtors who can offer you valuable rebates. This means that during a home purchase or sale, a portion of the commission can be rebated back to you, putting tangible money back in your pocket. This is a direct saving that many traditional lenders or brokers simply don't facilitate or even mention. It's about maximizing your financial benefit from all angles of a real estate transaction. Lowest cost title companies with no settlement fee. Closing costs can add up quickly, and title fees are often a significant component. I've personally vetted and cultivated relationships with title companies that consistently offer the most competitive pricing, often eliminating common settlement fees that can save you hundreds, even thousands of dollars at closing. This is a tangible saving that directly impacts your out-of-pocket expenses and reduces the overall cost of your transaction. We fight for every dollar on your behalf. Most cost-effective insurance connections. Homeowners insurance is a mandatory expense for every homeowner. My network extends to reputable insurance providers who offer competitive rates without compromising on comprehensive coverage. This ensures you get the robust protection you need for your home and assets at the best possible price, further optimizing your monthly housing costs. We help you shop for the best value, not just any policy. It's not just about the rate, it's about the whole package. My goal is to save the typical client thousands more by optimizing every aspect of their home financing journey. I look out for your bottom line, ensuring that from the moment you consider a HELOC to the day you access your funds, you're getting the most cost-effective and beneficial solution possible. This comprehensive approach is what truly distinguishes coast-to-coast mortgage and my dedication to your financial well-being. We believe in providing a full-service experience that prioritizes your savings and long-term financial success. 3 quick pro tips for smart HELOC management. Before we wrap up, here are 3 quick pro tips to help you manage your HELOC smartly and maximize its benefits while minimizing risks. These are crucial for long-term success. Pro tip 1. Have a clear plan and stick to it. Don't open a HELOC just because it's available or as a just-in-case measure without a specific purpose. Have a clear, defined plan for how you intend to use the funds, whether it's a specific renovation, consolidating a set amount of debt, or establishing a defined emergency fund. Once you draw funds, have a clear repayment strategy in mind. Treat it like a serious loan, not just extra spending money. Discipline is your absolute best friend when it comes to managing a HELOC effectively. Without a plan, it's easy to fall into the trap of accumulating debt without a clear path to repayment. Pro tip 2. Understand your terms and potential payment shifts. This cannot be stressed enough. Know your drop period end date and what your payments will look like when you transition to the repayment period. Understand the variable rate index your HELOC is tied to and any rate caps that limit how high your interest rate can go. If you're currently making interest-only payments, calculate what your fully amortized payment will be well in advance, so there are no surprises when the drop period ends. This foresight allows you to budget and adjust proactively, preventing payment shock and ensuring your financial stability. Review your HELOC statement regularly to track your balance and interest rate changes. Pro Tip 3. Monitor your credit and home value regularly. Keep an eye on your credit score, as a significant drop could lead to your lender reviewing or even freezing your line of credit, potentially cutting off access to funds you were counting on. Also, be aware of your home's market value. While you can't control the overall real estate market, understanding your current equity position helps you assess your financial health and the continued security of your HELOC. If your home value declines significantly, your lender might reduce your available credit, especially if your loan-to-value ratio exceeds their comfort level. Staying informed about both your personal finances and your home's value empowers you to make timely decisions. Conclusion. A home equity line of credit can be an incredibly versatile and powerful financial tool, offering flexible access to capital for a wide range of needs. From value-adding home improvements to strategic debt consolidation and robust emergency preparedness. When used wisely and with a clear understanding of its unique revolving credit structure and inherent risks, a HELOC can significantly enhance your financial flexibility and help you achieve important life goals. However, it's crucial to approach a HELOC with caution and a full awareness of its variable interest rates and the fundamental fact that your home serves as collateral. Responsible management, a clear plan for usage and repayment, and ongoing monitoring are key to leveraging its benefits without falling into common pitfalls that could jeopardize your financial security. My commitment to you is to provide not just a loan, but a comprehensive financial solution. With our new fully automated HELOC application at digitalhelocs.com, we've made accessing your home's equity faster, easier, and more transparent than ever before, with a credit-safe, soft pull process. But my value extends beyond just speed and technology. I look out for your entire financial picture, connecting you with realtor rebates, low-cost title companies with no settlement fees, and cost-effective insurance connections. It's about saving you thousands more and ensuring you get the whole deal optimized for your bottom line. Ready to explore the smart uses of a HELOC and see how your home's equity can work for you? Take the first step towards unlocking your home's potential. Visit digitalhelocs.com today to begin your easy, credit-safe application, or call my office directly at 804-212-8663 for a personalized consultation. Let's make your home equity work smarter for you. Thank you for watching.